Hello and welcome to this JPMorgan special. We are joined by the Brains Trust of JPMorgan India ahead of their India Investor Summit. With me, Sanjay Mookim, Head of India Equity Research and Strategy at JPMorgan, Sajjid Chinoy, the Chief India Economist at JPMorgan, and Madhav Kalyan, who is the Senior Country Officer and India CEO of JPMorgan. Gentlemen, thank you very much indeed for joining me. Well, so many questions bristling. So, Sanjay, first to you.
Sure.
This is a fantastic rally we have had, and FIIs seem to be loving India.
Yes.
You think this can last?
Well, I think the answer to that is how long, right? And the one big pushback I get from all my clients is that at now India is benefiting because it is not China, right? Within the EM context, there's a lot of issues with many other peer economies. There's a lot of uncertainties, and India is one of the economies that is decoupled, or at least believed to be decoupled, from the troubles of others. And a lot of investors mechanically went underweight India early in the year, because for 20 years, Lata, the lesson we've learned is that you should sell India when oil prices go up, right? It's worked almost every time. This is the first instance where Indian equities have outperformed despite higher oil prices. And what is happening now is that people are getting pulled into looking at India because it's outperformed, and there are other issues.
And so there's a FOMO.
There is a bit of a FOMO in many investors, and frankly, there's a lack of choice in investing elsewhere.
No, I take your point, but there are people who are making a special geopolitical argument which may last longer. For instance, China and Russia are uninvestable. Even the other BRICS countries, South Africa and Brazil, are, Brazil has political uncertainty ahead. So the argument, especially vis-a-vis Russia and China, if you exclude these two as investable opportunities, then India becomes like absolute, are there fund managers who are telling you, who are at least wondering if there will be a ex-India EM? So India gets special allocation. Are we heading towards that?
There is conversation.
More than passive flows.
Well, there are conversations around it, right, Lata? And yes, it's come up in many of my discussions. But the problem is that the benchmark indices still are EM indices, right? And you are at the moment, yes.
But do you see in a year or so that
I don't know, and that's my initial comment, right? We don't know how long this remains decoupled, when this kind of breaks apart. Okay. But the trouble we have specifically now is that Indian equities have become especially expensive. Right. So while the allocation decision looks okay, I need to look at ex-China, ex-Russia, many other parts of EM. But when you start executing that trade on the ground and say, okay, now what do I buy in India? That's when people run into a bit of a wall, because the growth value combination is very difficult to find in India at the moment.
Fair point. Sajjid, lay out the growth trajectory. Clearly one of the fastest growing economies. To what extent can this be muddied by the expected slowdown in US, Europe,
yes.
China?
So a couple of things, Lata, just 30 seconds on the global setup. I think the good news is the risk of a global recession has receded. Both consumers and firms in the US are holding up much better. So we don't expect for the US to go into recession in the second half of the year. You're seeing more fiscal support in Europe, and China at least seems to be kind of middling in the next quarter or so. So that's the good news. The not so good news is because we haven't got a recession, the disinflation may not be as large globally as we had wished and hoped. So you look at the last CPI number in the US, core CPI goes 0.6%
yes.
month on month. What that means is central banks will have to be more aggressive and almost engineer a recession in 2023 to disinflate. And that's the bigger concern, that we're now looking at more rate hikes. People expect the FOMC to raise its terminal rate. And so you're facing this double whammy or triple whammy. One is higher interest rates. All four central banks are expected to move 75. The Fed, the ECB, the Bank of England, the Bank of Canada. A stronger dollar. The dollar is the highest in 20 years. And while commodities have corrected, oil is still in the 90 handle, which is uncomfortable. So it's a pretty hostile global backdrop. As Sanjay pointed out, India's growth prospects are strong. I think medium-term prospects have been strong for a while. The geopolitics, the fact that, we're friend-shoring, China plus one. China is vacating so much space in the labor-intensive export markets of the world, textiles, gems, and jewelry. This is our opportunity, and people see that over the next 5 years. But in the next 4 quarters, we'll have to hunker down. Because at this point, you will get no rewards for focusing on growth. You will be judged on whether you can preserve and protect macroeconomic stability. So for all emerging markets, the focus will be bring your fiscal deficits down, keep your current account deficit contained, keep inflation under track, and ensure that you can protect stability. So I think that has to be the overriding focus in the next few quarters.
Oh, of course. Madhav, on the context of this China plus one, I didn't expect this conversation to come up so quickly in the discussion. What are you picking up? I mean, we did see huge amounts of equity into startups, PE, and then we saw that receding. But is this PLI and other China plus one factors really bringing in foreign money? Are you hearing any chatter?
Thank you, Lata, firstly for having us. And we are very excited to actually take our conference into physical mode. After 3 years.
Welcome.
We have about 200 investors in different asset classes coming. And that shows the interest in coming and hearing the India story from policymakers. Coming to the specific, I think India is an important point of discussion in boardrooms because of a set of factors. One, there is slowing global growth, and this is a market that offers huge growth potential. That continues to be a part of this conversation. When we talk to MNCs worldwide, we hear that consistently. The second is, even as they are looking at diversifying supply chains, India figures prominently in the conversation in the context of what we've done with PLI. But these are slow and deliberate conversations because this is a large investment that comes in.
Yes.
And so while the conversations are very promising, and we've opened up 28 odd sectors, 7 or 8 we see very good traction in the conversations that we're hearing.
Okay.
Private equity is always, it follows its trend.
But
they do make
private equity is using the domestic rally to exit. Do you see that as a trend that will continue?
I don't believe so. What we see is private equity moving to public markets is a maturity of a company's size and the continuum of what really needs to happen. We are in fact seeing a lot of private equity conversations that are around control and wanting to have control transactions in multiple sectors. We are seeing that in healthcare, we are seeing that in financial. They want to get their heads in. They see it as an opportunity to build scale, get in with control, consolidate other plays, and we continue to see significant private equity interest. There are some of the biggest firms going and raising India-only funds at this point in time. So we don't see them actually, exiting.
Looking for an exit opportunity.
A market offers an opportunity, obviously they will. Look at opportune ways to harness the investment that they've made.
But those are tactical.
Yeah,
they strategically want to get in. Okay, I read your reports, Sanjay, and what seems to worry you is perhaps Sajjid telling you that this is a K-shaped recovery. That means, the GDP may have grown only 2% or 3% compared to 2 years ago, but an outsized portion has gone to formal companies, to the rich. How does that drive your investment picks?
So it's a very interesting question, Lata. And for a while, what we had been arguing is you follow the economy and you look at companies that benefit from that K-shaped recovery and sets of consumers. And therefore, we were very aggressively underweight the staples, for example, because we'd argued that the outcomes will be poor. At the moment, we've taken the contra view.
Okay.
Right? And this is because my investment thesis is very simple, especially if you are like a one-year investor, is you don't just buy growth. Growth is for private equity or 3-year, 5-year investors. Long-term, India looks great, as all of us have tried to highlight. But in the short term, what matters are earning surprises.
Okay.
What companies deliver versus expectations. And where is
that?
And so expectations are very high. And that is the big problem at the moment.
For the discretionaries, for the sectors catering to the rich.
Exactly. So while that momentum is true, and we updated that data last week and in our note, and it's still valid that the recovery trajectory for the richer cohort is faster than that for the, let's say, the lower income cohorts. But the expectations of growth from companies exposed to that rich sector now are very high. Okay. And any sort of sanity checks will tell you that in 2 quarters, you're starting to get a huge bunch of potential downside risks to numbers.
Okay. So then where is the positive surprise, if any?
So our first of all starting point is that the market looks very toppish, right? And again, I keep going out to clients and say, look, let's not confuse the promise, which is a 5-year, 10-year, 7-year vision, with what is going to happen to markets in 3 or 4 quarters. Yeah. So there are 2 or 3 separate drivers of those outcomes. And India's market exceptionalism that we've got, because India outperforming China, I can rationalize. India is now outperforming the SPX in dollar terms. Very difficult to explain because the SPX is cheaper, it's got better earnings growth in the short term, and it's a hard currency asset.
Yes. Right?
So this looks very tenuous to me, and at some point there is a risk of a bit of a catch-up. Okay. So our portfolio positioning, therefore, is large cap, quality, defensive kind of stocks, which would be, let's say, the banks, the staples, and if you want some growth, maybe some real estate to add to that.
I'll come back to the banks argument after analyzing, rupee and rates. How would you worry about the rupee at all, Sajjid? Trade deficit is an issue, but at the moment financing is coming. The FIs are biting.
I would not worry about the rupee. There is no need to panic. This is not 2013.
CNY is over 7.
Yes, because we're seeing.
So should we not catch up?
So 2 different things here. We're seeing the strongest dollar, the DXY index, in more than 20 years.
Yes.
And when that happens, all emerging market currencies, all developed currencies will depreciate. And this may not stop anytime soon because the Fed has potentially much more distance to go. Now, the rupee discussion has to be, should we be using the exchange rate as a shock absorber? And I believe we should. When you have a current account deficit that's quite elevated and expected to remain elevated, there are 2 ways to bring it down. Either you really squeeze growth and demand and imports, which is not ideal, expenditure restraint, or you use expenditure switching, where you let the real effective exchange rate depreciate. Over time, exports pick up. Over time, imports are replaced by domestic substitutes, and you get what I call an expansionary reduction in the current account deficit. Right? So my hypothesis is always, let's do that. And I think one other point I'll just make is, remember, the current account is inextricably linked to the fiscal deficit. Right? These are the current account, just the investment savings balance. So if you bring the fiscal deficit down, it allows the private sector to recover without the current account deficit ballooning. So for me, the combination is continue with dogged, credible fiscal consolidation and let the rupee become the shock absorber.
What you want is one thing, but do you see the rupee going to 81?
Very hard to predict when, Lata, but I would argue that over the next 3-6 months, if US rates keep going up and the Fed is hiking into 2023 and the DXY keeps strengthening, there'll be very few reasons to keep expending reserves and not let this natural adjustment happen. When you're faced with a negative terms of trade shock, your equilibrium real exchange rate should weaken, and we should enable that adjustment in a calibrated manner.
I have to take a break, but just this, at the moment our FX reserves, I read in your report, are down to only 9.5 months imports. So but the big reserves, is it...
now, we bought those reserves so we could use them on a rainy day. It is raining.
Is 9 months, 8 months, 7 months, any...
There is no science to this. 9 months is very comfortable. I think the more important metric is reserves as a function of your gross financing requirements for the next 12 months, current account and capital account. In 2013, we were 1. We're more like 1.5. There's no panic here. But we should use it for competitiveness to become a shock absorber and keep those reserves in case these global turbulence goes on for another 2 years.
Fair point. Welcome back. I have been speaking to the brains trust of JPMorgan India, Sanjay Mookim, Sajjid Chinoy and Madhav Kalyan. Gentlemen, thank you very much for your patience. Well, I was going to ask about the Capex boom, and all of you have a rule there. First to you, Sanjay, are you seeing even some straws in the wind in terms of companies doing Capex?
Well, the answer is both yes and no, Lata. There is improvement.
On the sector you look at.
There is improvement. You have genuinely seen positive intent from steel companies, from cement companies, etc., which is better than zero, of course. But the one point which I keep making to all my clients as well, you need to scale all these announcements to the size of the economy, to the size of the corporate sector again. I mean, the Indian economy is up 3 times, right? So 1 power plant in 2004 is equivalent to 3 power plants now, or 3 cement companies now. And therefore, you can't just get excited by a bottom-up counting of announcements. You need to scale it to where the economy is going. And frankly, that number hasn't really moved too much yet. Now, if you look at the total Capex in India, the corporate sector is about half of total capital formation. Households are 30%, and the government's anywhere between 15 to 20% of capital formation. And our hope is that the current conditions catalyze a housing construction cycle because affordability is up, hopefully rates will remain contained, and that's a separate debate, by the way. And that creates demand, which then starts to fill in the conditions for a corporate capex cycle eventually. But at the moment, there are some green shoots, but not enough to get excited about.
Okay. What's your sense, Sajjid?
Again, the glass half full, Lata, is that the twin balance sheet problem that plagued us for a decade is now gone, has been ameliorated, right? Yes. Bank NPAs are lower. Corporate debt to GDP is the lowest since 2005.
15.5 credit offtake can become 16%, highest in 9 years.
Yes, but we need to be careful because the GDP deflator is running at 11%. So you have to judge this in real terms, which is 5%. Not to say that there isn't encouraging news. My point is the supply side constraint is not binding, but manufacturing utilization, even in March, when you seasonally adjust it, is still at about 72%.
The governor said 75.3.
So I think that's the non-seasonally adjusted once you do the seasonal adjustment. And I'll just say in a world where you worry about global slowdowns and recessions, rates are rising, monetary conditions are tightening, let's be realistic that a broad-based private capex cycle will take time. The implication is the government has to move on with public capex. And there are two challenges. One is how do you bring your fiscal deficit down and yet continue the capex momentum, which is very encouraging. And how do you incentivize and enable states? Because they've traditionally been the movers on capex. So I still feel we need to do more capex by the center and states to crowd in private investment a year or two from now.
Okay. Well, Madhav, on that point, you know, somebody did a chapter and verse analysis of CMIE prowess data. And as of FY22, March 31st, there is supernormal profits of corporates. You know, we all know the earnings growth of last year and the year before. But an outsized amount of money has gone to stock markets, and actual increase in plant and machinery and gross fixed assets is actually down last 2 years running. But this is March 31st. Have things changed in the last 6 months? Are you seeing penchant for at least even inorganic growth?
I think what we are seeing on the ground is capex, private capex linked to what the government has done. And coming out of the crisis, I think the government with limited fiscal room has done a commendable job. And I would say in 3 buckets. One is creating digital infrastructure. This doesn't require a lot of gross capital formation, but the digital infrastructure building blocks that have been put in place, ONDC, account aggregator, digitizing healthcare records, they all are wonderful initiatives. Yes. Then there's services infrastructure. Data centers to support the digital economy, the digital growth that's coming. The banking system is as clean as it can get. In the last decade, we haven't seen the banking system as ready as it is.
Are companies talking to you all for
companies are talking
expansion
to us linked to government hard infrastructure, which is roads, which is the Jal Jeevan mission. So we are talking to people who are all the schemes that the government, cement companies, steel companies, non-ferrous metals, and some PLI-related linkages are where we are seeing capex at this point. Capex will really become broad-based to the point that Sajjid said when consumption-led capex cycles start kicking in. Right now, it is driven off government spending, which is being done really well. And we are seeing linked to that, we are seeing capex.
Okay. Well, I have to end with what the stock market wants to hear. What should people buy? I mean, is there still room for banks to run? After all, it looks like the bond index inclusion may come. If that, even the expectation is there, people will be willing to buy banks because there'll be mark-to-market gains. So do banks have more legs to run? Does the market in general have legs to run if you compare previous episodes of valuations?
Well, we are very toppish as a market, right? And while it is impossible to predict when the momentum peaks out, because currently the momentum is very strong, as you get richer and as you extend the market, the theme has to be to reduce the risk in equity portfolios. Like me, if you ask me when is the market going to correct, I have no idea. Nobody can model that. But I cannot keep adding mid caps, high growth, highly expensive stocks as the market gets more expensive. And what is, like I said, particularly unnerving is India's exceptionalism on a market side, ignoring the equity correction that we've seen everywhere in the world. This appears very difficult to extend.
Justify.
So on a relative basis, banks still look okay because When I talked about earlier earnings surprises being principal driver of stocks, there is unlikely to be any negative earnings surprise in banks, at least. Yes, we can talk of growth coming back, etc., which is potentially positive, but no disappointments are likely. So we still continue to focus on banks, which are also fairly priced, especially relative to their own history, right? So there is no extended valuation in financials, and so we still continue to focus our India allocations on large cap financials. Staples, on the theme again, Lata, that we are unlikely to see too many earnings cuts. Plus, it's a defensive sector. Numbers are not very volatile to begin with. And these are the two core sectors we like. As a house, we are very underweight the IT space. Yeah, because we still think valuations are very high, and the recession or the fears of recession in the US, or slowdown at least, could drive top lines weaker than people forecast.
Okay. Well, let me see if I can squeeze a 30-seconder to you. Is there any larger medium-term story? You spoke about ONDC. If you look at ONDC, account aggregators, the digital footprint, perhaps more people can be given loans by the banks than they ever could because we have data on them. As well, fertility rate is now in our favor. So is there a better medium-term story for us?
There absolutely is. And for me, it comes down to providing employment to the blue-collar workforce. And I think this is India's moment. If you look at all the global stars, this is very rare. Chinese wages have gone up. China's vacating massive amounts of space. People want China plus one. There is all this friendshoring stuff. I think the next 10 years is where India has to increase its export share in manufacturing. That creates the blue-collar jobs, not the white-collar jobs. And I think rarely has there been the confluence of so many favorable stars. Now, that requires a lot of hard work at home. Infrastructure, regulation, labor laws, firm size, but the opportunity is very much there.
Okay, on that optimistic note, Sajjid, Sanjay and Madhav, thank you very much for joining me. Have a great conference out there.
Thank you for having us.